Good morning. Welcome to a What's Up with the Market. We're going to go through market status today. I'm going to bring in a couple of extra sector indices that we're going to look at on the Australian market related to what's happening with the commodities and prices. And we'll have a look at that. Before I do that, reminder that none of the analysis I do here is used in SPA3 Investor or SPA3 Trader. They are purely 100% mechanical systems. And I don't use any of the analysis I do in this session, the sentiment, breadth of market analysis that I do, the weight of evidence, if you like. There's no weight of evidence in my decision-making for what I sell and how much I buy or sell in the public portfolios or in my own personal portfolios that I run using the mechanical systems. I'm a mechanical trader and have been for decades, and precisely follow our systems for my own money. I was asked a question by one of our customers yesterday, exactly, and yes, I can look them in the eye and tell them I do. Everything I cover here today is general investment advice. There's no personal or specific investment advice. Okay, that said, we can get straight into the analysis, starting with the Dow, where I normally do, and most of you, if you staying connected and tuned into the market indices and what they're doing, would notice that there's slight differences between how the Dow has been trading in recent times. Sometimes the Dow's up and the other two major indices, the S&P 500 and the NASDAQ, are down a bit, and vice versa. And if you listen to the radio, they tend to tell you whether the market's up or down in the US overnight based on the Dow Jones, which they shouldn't do, but they do. Right, Dow Jones made a new high a couple of trading sessions ago, new all-time high, tiny retracement of 2 days there. This that I brought your attention to down bottom right here, which is a relative strength, comparative relative strength against the S&P 500. And we use that to donate whether the larger 30 Dow constituents versus the S&P 500, the broader market, which one has got the upper hand from a relative perspective. And typically what we read into that is that if the Dow is rising more than what the S&P 500, or not by falling as much, that is a risk off. And when the S&P 500 is rising by more than the Dow, that's a risk on. And at the moment, we're in no man's land. We're in this, we can see there was declining there while the Dow Jones was rising. S&P 500 was rising by more, and therefore we saw this relative strength line fall. We're going sideways at the moment. So a little bit of indecision. They're kind of matching each other, which does happen, obviously, but it's an indication of a little bit of indecision. We look at the price, the raw price action, and both are rising. And to get a risk on means that the smaller cap stocks and that make up the constituents of the S&P 500 need to start outperforming the larger cap, or at least rising with them, in which case we'll see the S&P 500 rise to 4. So first bit of information look into here. There's a little bit of indecision happening in the market at this point. And the other thing I want to bring your attention to, which I'm going to make a theme of today, which Don raised the last session I did, was to look at swing charts. And a very good point. And you can see here that this upswing has completed. Why is it completed? And you'll see a difference in a moment to the S&P 500, because it's a 3-day swing chart. There's been a lower 3-day swing down, right? And then we're looking at the lows here. But there's higher high, higher low, classic stuff, new breakout. Last time we were talking about this, we were in the middle over here. We were on this upswing somewhere in the middle over here. And we didn't know where the next high was going to form. It's formed. And it's formed at a new all-time high, which is typically a strong indication of this bull market continuing. So a little bit of indecision showing down here. Why? Well, typically when you have such a long swing up, using a 3-day swing chart, look at some of the other longer ones over here. They can go quite long and they can go quite short. Is a new all-time high. The buyers and sellers are going to come into a bit of equilibrium at this point, and then we're going to wait and see who wins the arm wrestle to see where the next leg is and how far that leg goes. So you can expect this for a few days, and you can go back to get an idea of how many of those few days could be. But new all-time, a large swing, expect a little bit of equilibrium and a bit of an arm wrestle going on, and we'll see which way it pans out. The odds are in favor of this going higher. We'll probably see a retracement for another 2 or 3 days, or a bit of sideways movement, and then we'll get a breakout one way or the other. So that's basically the theme we have for today. Moving on to the S&P 500, I'll put a swing chart on here, and you can see the swing has not completed yet. So we're in the upswing. We need to have a lower low over the last 3 trading days, and then that upswing will complete. So this could go higher before this upswing completes. The other thing to note here is that volatility is dropping quite strongly. And look what happened over here. The last time we saw volatility drop like this is it stayed at a low because it can't go much lower really, but the uptrend continued. Typically, people will tell you when volatility drops in an upswing or a bull market is that's the end of, or we're getting to the end of the bull market, or the upswing, or not talking about a primary bull market, maybe just a little secondary bull market upswing. But it can continue for some time as we saw here. But that's an indication. It's a good indication. We're coming down from a higher volatility level. So another, if you like, weight of evidence tick in the box here that we have got a primary uptrend that's happening over here. The new high, new low is not telling us much, except or just really confirming that we have got more new 52-week highs being made than new 52-week lows at a new market top, so that's bullish. The cumulative advanced decline line, what I look for here is the gradient of the moving average, the green line, and the gray line, which is the actual advanced decline line, and also this gap that's forming. I've kind of got a bit of what I might call a spine, if you like, this black trend line. And it goes through the middle here, and you can see there's a gap forming. There's a bit of delta forming above the trend line, which is showing strength as well from an advanced decline perspective. Breadth of market indicators, a little bit of a fall off over here of the number of stocks in the S&P 500 that are above their 150-day moving average, but we have higher highs and higher lows here. So in this breadth of market line, and the market's rising down here. So that's bullish at the moment. No divergence to see there yet, but we'll keep an eye out for divergence. None there. The US dollar, key, as you've heard me say, in picking short-term directions and maybe even longer term. These lines, these trend lines that I have on here are showing the times where they diverge, when US dollar and equities diverge, which is what we want. When the dollar rises, typically like that, dollar rising, typically you will see the markets falling off a bit. The moment the dollar is falling, US dollar, this is a basket against 6 major currencies, S&P 500 rising, and you can see the relative strength line between the two has been falling for some time, causing this smooth index rate of change indicator, this trending indicator here, to start dipping. When it crosses over the green line, we'll have a situation here where it'll be risk on. It's heading in that direction, not quite there yet. So some of these, if you like, alerts, these early signals that we've been looking at in the last month or so, where they were all going in the opposite direction, i.e. risk off indications, we are now seeing them starting to move towards risk on again. Not completely there, but we don't ignore price action. Price action comes ahead of all these indicators that we look at, but the indicators are starting to now slowly move in a direction to back up the price action. The growth versus value, we've had a risk on form over here, meaning growth is starting to outperform value. So that is one little tick in the box on the weight of evidence that we're looking at here in favor of risk on. The discretionary versus staple sectors, not so. We can see this is still falling. The relative strength here is showing that discretionary is underperforming staple. You can actually see it in the raw price action. Staple rising, discretionary falling to going sideways. So that's one negative, if you like. There's not a tick in the box for bull market. So we'll keep an eye on that one over the next couple of weeks. Put versus call ratio, one of the early signals that came, one of the early signs of a risk on environment. You can see this, put a trend line in here as well. Lots of lower lows occurring over here in the direction of the 252-day simple moving average is heading down. And we've got more calls being bought than puts being called in this market, and has been for some time. Bullish. The 10-year, this is a 10-year treasury note. This is yields. Yields are falling. Fell out the bottom of this rising channel over here. I'll leave that channel there for some time. Smooth indicator starting to turn. The relative strength between equities and bond prices is falling. That's the daily measurement of the ratio. There's the index rising. So if this continues, if yields continue to fall, we'll see the smooth indicator, this crossover that's moving average, and that will be risk on, not quite there yet, but heading in the same direction. And bonds inverse to yields rising. And what we want to see typically is bond prices and stock prices head in the same direction, not all the time. And I've shown some divergences here where they go in opposite directions. So that is the way the markets move. The fear index, the VIX, is dropped out the bottom of this channel. I'll leave the channel there for some time. What have I got here? A 21-week or 105-day moving average Daily moving average is falling, showing that volatility is low, as I showed you in the S&P 500 chart using average true range volatility. Looking at the NASDAQ, new all-time highs, 2 in a row. The all-time high is this black rectangle I've got here. I have put another zone in there, the blue zone. What we are seeing over here, so we broke above that resistance zone. We're above. It's not as high above the previous all-time high, which is the black rectangle here, as either the Dow Jones, the S&P 500, or the NASDAQ 100. But it's starting to make up some ground. How do we know that? This relative strength line here is rising, meaning that the NASDAQ composite is outperforming the S&P 500. And now we're seeing the risk off is still on, but from that red vertical line I've got here, where it dropped out of the below 90 on the Ciroc, and now it's starting to rise again. And when that crosses, if it crosses, shouldn't predict the future, we'll have a risk on using the NASDAQ composite relative strength to the S&P 500. So in risk on environments, we have the NASDAQ 100 and the NASDAQ composite outperforming the S&P 500 and the S&P 500 outperforming the Dow. That's what we're looking at from a sentiment perspective. The NASDAQ 100 is closer to crossing over. It's probably a bar or two, depending what the next 2 days hold for us. Looking at the Dow, we'd expect a little bit more retracement. It has been a bit stronger than the others, but looking at the S&P 500 and the NASDAQ composite and the NASDAQ 100, the odds are that we're going to go a little bit higher in the next few days. So a little bit of that's indication, confusion, or new all-time highs. It's to be expected. What else we're seeing here also is that there's the NASDAQ 100 outperforming the S&P 500 as the NASDAQ composite is. Risk on. So we're above. There's the previous all-time high, that black rectangle there that I've drawn for the NASDAQ 100, and a little bit of resistance here. And now above that resistance, I've left the channel line there to see if it gets back into the channel. And if it doesn't, and let's have a look at this. We'll have a look at the swing chart. This swing up has not completed yet. As I said, we need a new 3-day low. So there's the confusion that reigned at this all-time highs that occurred there. Dip back out of the channel, approaching the channel, but new all-time highs. This is risk on. You can see the trailing indicator starting to risk up, to trend up over here, to rise as well. The NASDAQ new high, nothing to see there. If anything, there's starting to be a flattening out over here. I'll have to update this Reddit where we've got it going back to somewhere over here. This gap's getting a bit wide, and you don't see the variations as much. A bit of work to update it, but I might do that just to bring it to a bit closer to more recent data. But it's starting to just fall a bit there, which you'd expect from a new 52-week high low in a rising bull market on the NASDAQ 100. You'd expect to see this rising a bit stronger. Not quite so. The cumulative advanced decline on the NASDAQ 100 is doing what it should do, so nothing to report there. The number of stocks that are above the 150-day simple moving average on the NASDAQ 100, we're looking for divergence here. None there, so nothing to report there. So breadth of market is in line. Higher highs are being made in that breadth of market indicator. The semiconductor sector of the NASDAQ exchange, we are looking to see if semiconductors are outperforming the NASDAQ 100, and they weren't over there, flat, slightly rising now. The Ciroc indicator has kept us in a risk-on environment over here, despite that pullback. I'll leave that trend line, that channel zone over there, to see if the price action moves back into it. It's pretty close to it. There's the previous all-time high, and everything, the moving average on the relative strength line here is rising. So slight outperformance at the moment in the NASDAQ 100, but certainly not as strong as what we saw back over here. But no early signs of any bearish price action in the stocks. Right, into the Australian market, we had a sell signal over here. We fell back, new all-time high, back into the range, now back above the all-time high. And we're seeing down here in the relative strength, the All Ordinaries underperforming the S&P 500, which is what typically happens in a risk-on environment. A risk-off environment is where the more sedate All Ordinaries index will outperform the more volatile S&P 500. So this is doing what it should do. And the Australian market, there's the all-time high that occurred on the 28th of March. Got pretty close to it, again, from a close perspective. And now we've got a little bit, very short-term symmetrical triangle forming over here, which is indecision, which would typically resolve in the direction of the previous trend, which is up. So we are looking at potentially a new breakout in the Australian market over the next week or so. With the weakness in the US dollars comes some strength in the Australian dollar, but still in this long-term downtrend. So not really breaking out into any new highs. If we see a raging bull market in the yes, like we saw over here in the equities in the United States, we'll see a weaker US dollar, which will turn into a stronger Australian dollar. And with some movement in resources, which we'll have a look at the moment in the Australian market, that might bring some Australian dollars into Australia to invest in those sectors and put some pressure on not pressure on downside, upside pressure, buying pressure on the Australian dollar. So we'll keep an eye on that. Right, the Nikkei has had a bit of weakness after a very strong run. You can see it started outperforming the S&P 500 as it's got a bit stronger, and it's just risen to above. That's its previous all-time high from way back in 1989, and it's fell below it again, and now just risen above it. So it's tussling. You'd expect it to after getting to what is it, a 35 year period of, is that 1989, 1990? Yeah, sorry, 40, 1999, no, sorry, 35 year all-time high, is that it would get some resistance around that area. So, and that's what's happening. So it might zigzag above and below for a while, and then it'll resolve itself one way or the other to the upside or the downside. But the DAX, I'll just cover this and one more international index, and then we'll move to commodities. There's its previous all-time high way back in August. It should be. No, it actually made one after that. No, it is. Sorry, it is. That's correct. In September 2021, it's further above its previous all-time high than all the other major world indices. So it's done well, broken up to a new high again, some resistance over here. We'll have a look at a swing chart to see how that's formed. Higher high, higher low, new all-time high, and a 3-day swing down, and we'll see how that plays out. But that's classic swing analysis, outperforming the S&P 500 as well. And just looking at the FTSE, its new all-time high breakout, it's been pretty strong, and it's also had a slight retracement. There's a good leg up, but that surprises me because it's really been in the doldrums for some time, but an indication of risk on around the world. Not quite so in developing markets yet, just using the Bovespa all on its own as an indication of how they're doing. All-time high area over here, resistance, slight down channel there. I could put a channel over there to look for the breakout. Might do that for the next one, but underperforming the S&P 500, so developing markets not taking part in this at this stage. Right, move on to commodities. The CRB index is also having an arm wrestle around this resistance zone here, and underperforming equities most of the last, 9 months or so. A little bit of uptick there and a downtick, and we'll see where the strength in the CRB index is coming from. The gold's not in it, so it doesn't affect it. But this is a real classic uptrend in gold. Outperform equities, slight underperform of equities when it had the retracement, but it's staying in this, sorry, shouldn't say staying. I've actually redrawn this channel to take in this low over here because it got back into the channel. So one of my sort of subjective rules I use for drawing trend channels, and it's staying. Well, it's obviously staying in that channel now because I've just redrawn it. But that is classic uptrend, new all-time high, and then a test just one bar down after that. The story of the last couple of weeks has been silver. Sure, it's rising. It hasn't got to its new all-time high, some way away from it, but certainly broken out of this down channel. But just zooming in a bit more, this is a relative strength line between gold and silver. And you can see silver has been outperforming gold for quite some time, and now it's had a big breakout. So this price action relative to gold has actually been stronger than gold. And typically when gold bugs kind of locked into the trend, the breakout, or any trend that's formed that has credence behind it, then typically silver catches up. And the very fact of silver catching up gives more credence to gold, to the gold trend that's in place. So this is a positive thing. Quite often you'll see gold trend up and silver not follow and not catch up. But when it does do its catching up thing, that adds, as I said, credence and strength to behind the trend that's in gold as well. And that's what we've seen. So this gold breakout, jury's still out in my view, but it's adding more credence. This could be a good strengthening trend that continues for some time. Next is copper, and copper also outperforming gold down here. I have at the bottom. So after underperforming it for quite some time, and also to a new all-time high. This previous all-time high was all the way back here in 2010, 11, and then flirted with new all-time highs over here just in the last 2 or 3 years, and now has had the breakout. Of course, everybody's talking about copper, being a very important metal and all the things that are happening around the world at the moment, but that is a strong trend. And when I've been talking about this trend, I've been saying, let's see how it plays out. Typically, it plays out, and you start to see the term come back, and bellwether of world economy is typically what copper, or Dr. Copper is what it's called. All those terms which have been missing for a long time are all starting to be used again amongst market commentators, and that's because of this price action. So we'll have a look at some resources indices in a moment. Oil has had a bit of a retracement, broken out the channel, which I'll leave there for a moment. It does play a big role in the CRB index. So that's going to have an effect, a deflationary effect, which people are looking for at the moment. Bitcoin has had a big rise to try and test its all-time high up here. I've left this all-time high in place there. I haven't moved it up yet because it's fallen down below, and I'll leave it there until we have a clear breakout. And where was that previous all-time high? All the way on the left. There were 1-2 big touches back here. The last was in November 2021, and the one before that was in April 2021. Big gap over here. Reached that all-time high. Some resistance, which you'd expect after a good run-up, and fall back into the trading range, and now a breakout above again. There's the Ciroc indicators given an indication to buy 3 or 4 sessions. Trades all the time, but sessions that end on a 24-hour end of trading session. And so that's up. And Ethereum is also following suit as well, with a big catch up and overtake, and also has given a buy signal on a subjective, not mechanically tested Ciroc 26.9. Looking at other indices, uranium continues its rise up, and as does iron ore. Jumped off this, found resistance at this trend line I've had there for 2 and a bit years, and fell into the range a bit, and now has popped out again and found some, and it's around about their comfortable level of $120 odd, which has probably become a median price for iron ore for quite some time now. If you had to just over the last 5 years just draw a line through there. There it is there again. What's that date? July 2019. Yeah. So that's become a kind of a median price if you had to put a line through there. And lastly, looking at coal is forming a base, as I said. That base hasn't broken out above or below. If it breaks out below, it's not a base. If it breaks out above, it does become a base, and we'll only know that into the future. So just quickly today, I also wanted to look at some of the smaller and resource indices in the Australian market. And I'll start off with the small ordinaries, which is made up of small industrials and small resources, are the two main components that we'll look at in a moment. But it had a lovely run-up and gave it a sell signal in our SPAR3 investor timing. It kind of fallen, had a retracement, and now testing a new breakout and this resistance zone. So it gave an exit signal at this resistance zone, which you'd expect. This here compares the small ords to the all ords, and was underperforming for quite some time. And then we had this outperforming during this trend up over here. So even this section, when it was rising, it wasn't really outperforming the all ords. Here, recently underperformed the all ords. So let's have a look at what has caused the small ords to out and underperform the all ords. First we look at is the small industrials. So there was a run up. What is that? A 28% run up from October last year to this peak it reached in end of March. And then we've had a little bit of a 7% retracement. You'd expect that after nearly a 30% run up from trough to peak. Outperformance of the all ords, underperformance of the all ords just recently. That's the small industrials, which feeds into the small ords, so played a large role in the small ords rising. Next, we look at the small resources. Now, the small resources, going back to October last year, which is round about here, went sideways for most of that time. But at the end of February, it started rising. And this is where, and if you go and look at the timing of this, well, let's go and look at the timing of this. Let's go to here, and we'll go to copper. And you'll see that this started rising back here in February of 2024. And that trend took off. And now we look at the small resources. Where was it? The 23rd of February. So we were talking about the effect that has on small resource companies in Australia. Now this feeds into the story of the Australian dollar and how that's going, and maybe that getting strength, because This is what attracts international investors to our market because of our big resources, big in terms of number, but still market capitalization can still be an issue. But this isn't an uptrend. It's had a breakout above this resistance, this support resistance zone, still a long way. Now I've zoomed right out, so that looked, great, a 28% run up. But where's that relative to what it can do and where it is to the past? So there's a lot of room for movement in small resources. A breakout of this is relative to the all ordinaries, underperforming all ordinaries for quite some time. And you can see back here when it did, how much it outperformed the rest of the Australian market. And we haven't had that kind of environment for some time. I'm not saying it's going to happen this time, but it's still early days. This is green shoot stuff. And if this does turn into a trend on the back of copper, a little bit of silver and gold as well, but particularly copper, and there's other metals that are coming into play now that weren't in play back in the 2003 to 6 raging bull market we had in small and mid-cap resources in the Australian market, then let's keep an eye on this. So this is, I know it's been a move, a 21% move, but don't feel that you have to panic about this and get into it. These things take some time to play out, and there'll be plenty of opportunity for everybody. So we'll keep an eye on the small resources. And another one we use to confirm, the small end of town is the emerging companies. It's had a run up of 18%, not as much, but outperforming the All Ords. So when we start seeing the small end of town, the small cap stocks starting to outperform the large cap, we know that is also a risk on. That's going to attract people into the market, and that also feeds through into large cap as well. It creates a feeling, a momentum, if you like, a fad. Human beings love fads. They run it out, and momentum gets revved up, and that makes the market someplace. Then people start talking about it. Gets into all the shoeshine boy, as they used to say in the 1930s. And the cabbies start talking about it. We're nowhere near that yet. That's when you start measuring euphoria. It's the only way you can really measure euphoria. But this could be the start of something. I'm not saying it definitely will, but we're getting this at an early time, and that's why we keep an eye on these sectors. Now, I don't talk about them every couple of weeks, but you can see my analysis. I keep an eye on them every now and then. Looking at the mid-cap 50, which is made up of mid-cap resources and mid-cap industrials, sure, rising, nothing strong, slight outperformance of the All Ords and now matching the All Ords. But where's the strength coming from? Not from the mid-cap 50 industrials. You can see that's kind of matching the mid-cap, but this is where we're starting to see outperformance now as well. This is against the All Ords of the mid-cap resources. So the action here, this is up 16%. So we got small resources up 21%, and this is going back to just February. And we've got the mid-cap resources up 16%. So early days, we want to see the mid-cap resources has done a lot better of more recent times than the small-cap resources if we compare that period, just more recent, to what happened back here in 2003 through to 2006, or even all the way. So we had 6, and then we had a retracement, then another run up in 10, 11. So we are looking forward to see if that repeats, because if it does, we're going to have a really nice time on the All Ords, if it does. But these are small. These are really just early signs. Right, that is where I wanted to finish it today. We'll just go back and look at the S&P 500 and take any questions if anybody has. Ditmo is saying, in line with your current analysis, have you looked at bringing more mid-cap resources into SPA3 investor universe? At the moment, we only have the big miners and some gold stocks to choose from. No, I haven't. Well, sorry, yes, I have, and I do keep an eye on them. There aren't any yet that meet the requirements of having at least 10 years of data, and also being trendable and having sufficient liquidity to bring into the universe. It's if we want to trade small caps and do it on a and by definition we should be trading lower liquidity, lower market cap, more volatile, if you like, stocks that don't trend as well with a shorter term trading system. So bringing them into SPA3 Invest to have a half decent enough position size to be meaningful, where you got larger amount of capital, is not really going to help to grow your wealth. But certainly for what we do want to do, though, is take advantage of the opportunity when it comes, because as you can see, the last time we really had a huge opportunity in this sector of the Australian market. I'm not saying that we're going to have one, but there's some early signs that it may happen. It was 2003 to 6, 7, and then again 2010, 11. So it's been a long time between drinks. The way to do it with what we offer is SPA3 Trader. And that's where you can set up a satellite portfolio with some money in it, and you can call it fund money, because really what happens with when the small resources and mid cap resources and emerging companies, when these happen on a sustained enough basis, there's been little pockets of that happening for a few months here and there over that period of time, but certainly not enough to get a nice trend going in a nice strongly rising portfolio. Is when that happens, you want to take advantage of it, and that's when liquidity comes into those. So the 2 or 3 month lasting of liquidity, you can go back and look at the charts and see that happens so often. It's just like bees to honeypot for 3 or 4 months, disappear. But when it happens for 3 or 4 years, 2 or 3 years, that's when you want to be in it. And the way to take advantage of the liquidity that does flow into those sectors, and suddenly, the liquid stocks of the All Ords goes from 500-600 to maybe 1,000 that are liquid enough to really trade and put some portfolio size into. If that happens, we want to take advantage of it. And the way to do that with our offerings, with the Sharewell Systems offerings, is with SPA3 Trader. So a satellite portfolio, maybe 10, 15, 20% of your capital is something you could look at doing that. And that will be timely enough. It's a shorter term system, but when you have the way that those stocks move, is you want to have closer stops, closer exits, more sensitive exits, because as quick as the money goes in, it can come out as well. And you can see liquidity dry up in a matter of weeks. So that is why SPA3 Trader would be better suited to trading that end of the market. Don saying, Gary, is there an update on when the research work will be presented? No, Don, there's not. It's how long is a piece of string. The only thing I can tell you from a research perspective is, and I've said it a few times before, but I'll repeat it again, is that I worked for quite a few years on SPA3 income and went down a path of a timing system to bring that, to use the instrument of exchange traded options, and particularly in weekly options in the United States, to derive an income from. So they have a mechanical income generating system. And after much live trading with that, using Saxo here in Australia on the US market, and also using a US based broker as well, I found it impossible to be able to mechanize to the degree that it could be set and forget, and we could trade it, people could trade it from anywhere in the world, basically on the US market. So as I've said, I've given up on using that timing on the instrument of an option, and I'm looking at other instruments at the moment. And there's 2 main areas of instrument I'm looking at. One is leveraged ETFs, index ETFs, and a small basket of those to take advantage of leverage and short-term income generation. And it'll be trading for income as opposed to, and go long short, as opposed to writing calls type income or writing puts type income. And also looking at income type ETFs as well. There's a whole band of these, and there's a few that have been around long enough to really do some longer term testing on, i.e. 10 years of data. There's a handful of those, but there's a whole bunch of new ones that have popped up in the last 3 or 4 years that insufficient data, but maybe I can use for confirmation of the longer term ones, to put some timing on, ready to take out the big downside, because these things will move in a downward, and they do use puts and calls and do write options to be able to generate the income, but they pay regular distributions as well. So that's where my research work is at the moment. I'm not anywhere near in the short term, even the medium term, to saying that there's something to present, but it's always ongoing. It's effectively, research hasn't stopped in my life for since 1990 basically, if you go, but in earnest since probably about 1993. So it was okay. So the other research on stock filter timing, that is still ongoing, and I'm not doing that. I've been able to delegate that to somebody else. And sorry, I just should repeat your question. You did say that it wasn't about the option strategy, it's about the stock filter. And yes, and there's some other research we brought into that, where we are looking at a different market risk type timing mechanism other than the All Ords or the NASDAQ composite. So we're researching that as well. But as soon as we have something that we want to bring to you, I promise you it's going to have to be quite, it's going to be ready to announce, rather than letting you know this might be ready in 2 months' time. It's going to be pretty much finished when we do announce it. Don, that's what we'll do. But it's ongoing, I can tell you that. Yeah. Okay, to finish up and summarize, we're looking for this swing top to form in the S&P 500 and the NASDAQ 100, and also the NASDAQ composites already formed in the Dow Jones. And to form that top and see where that top forms, And then when that peak forms, there will be a retracement. We want to see how deep or shallow that retracement is. And just to finish off, which I haven't discussed, but we can now say this is done, is that the retracement that we had on the S&P 500, which we were watching, the Fibonacci retracement, did stop here at 23.6. So we can say that retracement is done. Why? Because you've made a new all-time high now, and that is very bullish. The fact that it was only as shallow as a 23.6% retracement is bullish. Couldn't have called that last time we met because we were in no man's land over here, where the swing was still going up, and we didn't know whether we were going to form a peak then and then another low that could have gone below the 23.6 and down all the way to 38.2. We've now said, right, this peak is going to be above, and now we've got a new peak, which takes out that peak, which means that this Fibonacci retracement is complete because the next one we draw will actually be up there, and then we'll follow it from there. Thank you for your time. Hopefully that's been informative to you. No more questions. Won't be back in a couple of weeks' time on a Wednesday. It might be a different day, and we'll let you know in due course when it will be. And as always, I wish you consistent, objective, and peaceful active investing.